Right now we are certainly experiencing a very wild market period that is caused by a series of unprecedented events that defined the last 3 years. Just when it seemed as if the turbulent period characterized by trade wars, a fully fledged global pandemic, and subsequent major global supply chain issues would finally come to an end, Russia decided to invade Ukraine, the largest and deadliest military campaign since World War II. The Russian invasion led to rapidly increasing oil prices that are nearly 3 times higher than they were in 2019. Commodity indices had their best quarter in 30 years. Mortgage rates almost doubled, and of course, stocks are also suffering. The NASDAQ, for example, just had its worst day since October 2020. More than 45% of the stocks included in the NASDAQ index are down 50% or more, and more than 22% of the stocks of the NASDAQ index are down 75% or more. And this brings us to the topic of today's video. When stocks are experiencing steep price declines, but the underlying businesses themselves are fundamentally doing fine, I love to see the businesses and the businesses management to do buybacks. However, most business leaders shy away from buybacks when the market as a whole and the share price of their business drops. This can be frustrating for intelligent investors. So, is there a way to find out in real time if CEOs are stepping up and buying back their own stock when there is panic in the market? Well, generally it's incredibly difficult for investors to know whether a company is currently buying back its own stock. For US listed companies, for example, we get 4 quarterly reports, so one every 3 months, and that's it. But there is actually a trick to get a more up-to-date overview of whether share repurchases are being made, and I'll share that trick with you today. So let's get started. Alright, hey there, my name is René Zellman, and usually when you want to check whether a firm has been buying back its own stock, you would look at the company's most recent public filings. You take a look at the most recent quarterly filing. Let's say it's the company's second quarter. Well, then you would take a look at the second quarter results, take a look at the income statement, and then compare whether the total number of shares outstanding has gone down relative to the first quarter filing. So if we just consider a real example, we can head to Facebook's or Meta Platforms Q1 filing. It's 10Q. And as I said, on the income statement, we can see that as of March 31st, there are 2.742 billion diluted shares outstanding. If we now head to the company's 10K, so its annual report, which was filed 3 months earlier, we can see that as of December 31st, there were 2.859 billion fully diluted shares outstanding. So in total, Meta reduced the share count by 117 million shares during that 3-month period. Now that's a good start, but it doesn't tell us whether management is currently buying back its own stock and at what pace, now that prices are falling rapidly. As I've said, 10Qs and 10Ks are usually filed only a few weeks after the quarter has actually ended. So this brings us to the trick that I want to share with you in this video. Most 10Qs and 10Ks include more information than there appears to be at first. In fact, there is another document that you can consider, but I'll get to that later in this video. So let's start with the 10Ks and 10Qs. So if you just take a look at the cover page of these filings, let's consider Facebook's most recent 10Q again. You will see that most companies report an up-to-date share count. In Facebook's case, we can see that as of the date of this filing, so April 22nd, Facebook has only 2.706 billion shares outstanding. So what I was doing here is adding together Facebook's Class A and Class B shares. That's the total number of basic shares outstanding, not the number of fully diluted shares outstanding. So if we head back to the income statement, we can see that as of March 31st, the number of basic shares outstanding for Meta Platform was 2.725 billion. So in the 3 weeks between March 31st and April 22nd, Facebook repurchased another 19 million of its own shares. If we assume those shares were bought at an average share price of $220, that's $4,108 million worth of stock repurchases, or around 0.7% of the total shares outstanding. That's a fairly aggressive pace, and considering Facebook's current valuation, I think Zuckerberg is creating a lot of shareholder value here. And knowing this might actually give you an informational edge. Now, you can find the same information in a company's proxy statement, which is formally known as Form Dev 14A. According to Investopedia, issues covered in a proxy statement can include proposals for new additions to the board of directors, information on directors' salaries, information on bonus and option plans for directors, and any declaration made by the company's management. But that's not the point of this video. As I said, it also includes information about the current number of shares outstanding. And as this document may be filed in between quarterly results, usually when a company is seeking shareholders' votes ahead of an annual meeting, looking closely at this filing, they give you yet again an informational edge. Personally, I usually just hit Ctrl+F and then search the document for the word outstanding. For example, as of December 31st, Etsy had 127 million shares outstanding. That's the number we can find in the 10K. On April 22nd, Etsy filed a proxy statement, and you can see that the total share count was slightly reduced over the 3.5-month period between these two dates. Now, overall, I like to own businesses with management teams that allocate capital smartly, to assess whether management is allocating shareholders' capital intelligently. Just looking at one quarter is probably not a suitable way to assess management's capital allocation track record. So the best tip I can give you here in this video is to track what a management team is doing over the longer term. Are they buying back stock when the company's share price is depressed and below your intrinsic value estimate? Or are they just sitting on their hands when the market offers them attractive opportunities? And do they only ramp up buybacks when shares are trading at all-time highs? In the latter case, I would be very skeptical with regard to management's capital allocation capabilities. It's probably better to stay away from these investments. To give you one example here, RSCI Hospitality Holdings, ticker RIC, has one of, if not the best capital allocation frameworks I've ever seen. They allocate capital to buybacks when the stock trades at a free cash flow yield north of 10%. And if we now consider when they've bought back their own stock, we can see that management has acted when the stock trades below its intrinsic value, like in the period of 2016 and 2017, or during the pandemic lows, but stopped buybacks when they thought the stock was too expensive. And as an investor, you've got to laugh to see this. If you want to learn more about how you can spot management teams that can allocate capital smartly for their investors, and thus can create a lot of shareholder value, which can lead to marvelous long-term returns, I recommend watching the following video next. And with that, I'll wrap it up. Take care.